Hello, everybody. Welcome to the Fintech Combine. I am your host, Kris Kovacs, and this is the series where we talk with and sometimes about community-based institutions, their digital and business transformation projects, and we meet the innovators, entrepreneurs, and fintechs that make it all possible. On this episode, we meet with the president and CEO of Curql Collective about how they're changing how credit unions invest in fintech. So if you're ready, let's suit up and get out on the field. Nick, thank you very much for joining us today. I'm super excited to have you on the show. Why don't you start by telling our listeners a little bit about yourself and Curql?
Yeah, great. Thanks for having me, Kris. Happy to. So my name is Nick Evans. I'm president and CEO of Curql Collective. And Curql Collective is the ecosystem that is bringing fintech to credit unions. Prior to joining Curql, I was with Veridian Credit Union. I was there. It's a $8 billion credit union based in Iowa. And I was there 11 and a half years. And I was hired at Veridian originally. I still remember the ad in the newspaper. That kind of dates me a little bit, right, Kris?
It does indeed.
The ad in the newspaper and what I was doing when I found the ad and what was happening. But anyway, I answered an ad in the newspaper for a CUSO president at Veridian Credit Union. And so not being in the credit union space, one would say, what the heck is a CUSO president? Mm-hmm. And so I answered that. And I had run for the board at this credit union, actually twice. Wasn't elected, but got close. And so I knew the senior team, the C-suite there. So I called up a couple of those folks and said, what the heck is a CUSO president? And they said, oh, don't worry about that. You'd be great. You need to apply. And the ad specifically called out entrepreneurial experience and having bought and sold companies. And I had that experience. In fact, I had just sold my company. And so I thought I was retired. My wife said I wasn't. And so I did what they asked me to do, and I sent in my resume, and the rest is history. And I was fortunate to be at that credit union for 11 and a half years as the CUSO president, and it brought me into the CUSO space. It brought me into the credit union industry. I got to meet great people like you. We go way back, and so that's how it happened. So then, as I learned all the acronyms in the credit union industry, which takes a couple of years when you're not from this industry, I started getting more active in the CUSO world. So I ran for the CUSO board and was elected. Veridian joined MDC, which I know you're very familiar with, Kris. And and so Veridian was always very active in the investing space as well. So when I joined Veridian, I inherited some CUSO relationships, some CUSO investments from the 90s when CUSOs really started sprouting up, and that's back when 2 or 3 credit unions got together and said, let's solve this problem and start a company, and that's how CUSOs originally started. That's changed a little bit today, but still happens a little bit. And so I inherited some CUSO investments, and then we were the Series A round in a company called Dwala, which was going to change the payment landscape. Made an investment in Alchemy, made an investment in Move, which is still a big mover and shaker. Sorry for the pun. So we were notorious investors, I like to say, and we joined a venture fund in Iowa, a venture-based fund in Iowa. Iowa Code said we could do that, so we did that. And that was the foray into investing. And then MDC started the project around this concept, which we know is Curql today, but it was, is there room or is there need, not room, is there need for a strategic investment fund in the credit union space? And I was on that project team along with Ben from Michigan State and Martin from Sound, and people that were really, really invested in this space. And the rest is history. The project team at MDC turned into a business after the MDC contingent said, yep, this seems viable, let's roll. And I ended up on the board at the original company that was creating this concept, which ultimately turned into being hired as the CEO. So here I am today at Curql Collective. And so that's been my journey through the credit union space, through the CUSO space, to where we are today at Curql.
So, talk to me about what a strategic investment fund does, just for those who aren't familiar with Circle.
Yeah, that's a great question. So we don't use the term venture. We're not a venture capital fund. In my mind, venture capital funds write a check, hand it to the founder of a fintech, and say, "Here you go. Call us in 3 years when you're giving us 10 times this back." Right?
Right.
That's what venture capital is. We don't do that. We are involved and we are ingrained in their lives from the get go. And we are going to help them grow from the get go. So when they take our money and we're in the cap table, um, we are generally on their board. We generally know what they're up to the entire journey. We know when they're struggling, when they don't know how to talk credit union. We know when the fintech, needs to hire some people,
Mm-hmm.
and we know what we even know what trade shows, not trade shows, what conferences they're going to in the credit union space, because we say, how can we help you while we're there together?
Mm-hmm.
Those are the kinds of things a strategic investor does. But the key is a strategic investor brings customers to the table. And so we say we're a strategic investment fund because my job every single day, Kris, is when I wake up, and what my staff does every single day is we keep our fintech in front of our credit unions and our credit unions in front of our fintech.
Mm-hmm.
That's what we do. If we can help our fintech grow, and that's our job, that creates a win-win scenario.
Mm-hmm.
The fintech grows, their value grows, their product map grows, and therefore they can help the credit unions that they do business with grow. And so that's what we talk about. When we talk about Circle, we're strategic investors.
Mm-hmm.
Our value proposition is dual sided. We have a value prop for the credit unions and we have a value prop for the fintech, and those are married up in the middle. And so, when we talk to credit unions about investing, we say our very first priority is looking for that product market fit for credit
Mm-hmm.
unions. It's got to be strategic. In other words, they have to be serving credit unions in some operational capacity or improving the lives of a credit union member. If
Mm-hmm.
we can check that box, then we move into the possibility of the investment. And will the investment ultimately be a solid choice for credit unions? A
Mm-hmm.
venture capital fund will invest in 30 companies and hope two are home runs,
Mm-hmm.
and don't necessarily get concerned by the other 28 that fall by the wayside. That's not us. We're not home run hitters. We're doubles and singles,
Mm-hmm.
doubles, and a few triples.
Mm-hmm.
Might there be a home run along the way? You bet. But we're helping them get from first base to second base and some from second base to third base. And again, that dual sided value prop. If we
Mm-hmm.
can help them grow, if we can help the fintech grow, our credit unions grow. If we can help their valuation grow, our credit unions win in the long run. So
Mm-hmm.
that's how we look at it when we talk about strategic investing.
Are there particular characteristics for the fintechs that the fintechs ought to have in order for you to consider an investment in them?
Well, we look at everything, Kris. We look at first and foremost the team, the
Mm-hmm.
founder. Um, we tell credit unions today that investing in a fintech is a risky proposition.
Mm-hmm.
So, first and foremost, the founders have gotten more sophisticated. This might be their second or third run through. This just might be their second or third great idea,
Mm-hmm.
right?
Mm-hmm.
Well, what happened to the first and second ideas? Did they go out of business, or was there a happy ending? So we look at the team and the history of the team, and specifically the founder. Many times you're betting on the jockey, not the horse.
Mm-hmm.
And so it's very, very important that we understand the historical upbringing, so to speak, of the founder and the team. So the team is important. We hear day in and day out of fintech forming and starting new, and they understand that the team they put around them, the co-founder, the tech side of it, the people building the tech, the strategic
Mm-hmm.
advisors are all very, very important to the trajectory of the company.
Mm-hmm.
We look at their, obviously we do a deep dive on all the IP, all the coding, all the tech side. That seems like a logical comment, but we do a very deep dive. In fact, one of the things that people really like about Curql and what we do is that deep dive on the tech.
Mm-hmm.
In other words, if we invest in a company, there's a stamp of approval there around the technology has been vetted.
Mm-hmm.
We look at product market fit. We poll all of our owners. We let them see the technology
Mm-hmm.
first before we invest in it, and we get their opinion. In other words, we
Mm-hmm.
say to credit unions, did you like the product? What didn't you like about the product? What other products are out there that are similar? If we invest in this company, might you consider using them? We don't say the word vendor either. We don't say
Mm-hmm.
venture and we don't say vendor. So we get rid of the V words. Might you use them as a partner?
Mm-hmm.
Might you use the product and offer it to your members? So those are the kinds of things we ask ahead of time. And
Yeah.
that credit union opinion, those subject matter experts inside of credit unions, their opinion is very, very important. Our investment committee, again, made up of credit union executives who are owners in Curql, they're the ones that make the decision whether we invest or not. It's not
Mm-hmm.
anyone else. It's a committee of senior executives. They pay close attention to what the credit unions thought when we're evaluating that.
Mm-hmm.
So it's product roadmap, it's financials. Now, none of these early fintechs are making money. So that's,
Mm-hmm.
we understand that going in. We're not investing based on profitability or at EBITDA or anything like that
Mm-hmm.
because they're cash flow negative. And that's,
Mm-hmm.
but when are they going to be cash flow positive?
Right.
What's the outlook? Things like that. So there's a lot that goes into vetting a fintech, whether we'll invest or not. But I think I answered your question.
You did. No, and I think it's really forward thinking to consider, is there a bench of buyers, right, who will say, yeah, if you invest in this, we'll buy it, because as an investor, you get the benefit of that additional business, right? That's the beauty of the model, right? The beauty of the model is you are not, by helping the credit union, you are helping the fintech and vice versa,
And
right?
the
You're
other
able
word,
to.
the other word that's important here is scale, right?
Mm-hmm.
And so what we say to these fintech, and we get especially worried if they come to us and say, we're only going to concentrate on credit unions. That's the only thing we want to do. Well, that's important because, we're in the credit union space. And I say, and you can't not consider the banking side of it.
Right.
Because that's the only way they're going to scale. If the product and service, if the technology is good enough for credit unions, it's going to be darn good enough for community banks.
Right.
And so you look at companies that might have 700 credit union customers today. Well, where are they going next, right? What are they going to do in order to continue that trajectory and that hockey stick growth? Well, at some point they're going to have to cross over, and we tell them that. We say, it's fine to be credit union focused today, but you're not always going to be that. And, an example is Zest.
Mm-hmm.
Zest has done a fabulous job inside of credit unions.
Indeed.
Very popular company, doing great things around removing bias from lending. Now there's a fraud piece. Now there's an AI piece around their digital. They call her Lulu, and they're doing fabulous things. But they also are now starting to sell on the banking side. And we're okay with that. We understand that. And their other investors want that. And so they have to agree that to continue to grow and to take money from bigger and bigger places, which they did in December. And so, that's all part of the equation. Where are you headed? You can't rule out banks. You might rule them out today, but you can't rule them out forever. And so, and that's important. Again, we talk about scale and that dual-sided value prop. The value prop on the fintech side is we're going to help you scale. And it's important that you scale in order for us to reap the benefits of our original investment. We took some risk, and now, eventually down the way, there's got to be some reward. And to do that, you've got to be open-minded about where the products take you.
How do you take into account the credit union needs into your search for fintechs to invest in? How do they help you understand, hey, here are the challenges I see coming, here are the opportunities I see coming? Are there fintechs out there that will help me address those? How do you help make those connections?
Yeah, that's a great question. And we talk about this today with every credit union. It comes up with every credit union we talk to, and we're fundraising obviously for Fund 2, and so
Mm-hmm.
we're talking to a lot of credit unions. And what we say to them is, they all ask us, what's different between Circle Fund 1 and Circle Fund 2?
Hmm.
Not only what we're looking at, but specifically what we're investing in. So, I'll give you an example. Circle Fund 1 opened in April of 21. Well, Kris, what did everybody have in April of 2021?
They had capital.
Cash. When I say everyone, I mean credit unions. Right?
Yes.
Everybody had a lot of capital
Mm-hmm.
because it was all that, the COVID money,
Mm-hmm.
right? Everybody was just rolling in dough, so to speak. And they wanted to lend it out as fast as humanly possible. And so our first 3 or 4 investments were in lending platforms.
Mm-hmm.
Caribou with auto refinance, as an example. You get the idea.
Mm-hmm.
And so, people we didn't invest in, but Upgrade and Upstart, they were all going strong back then because there was so much money in the system that needed to be loaned out. And so, it was all about lending platforms. And then that shifted quickly, right? And then all of a sudden, here we are, 4 years later, and it's not about lending anymore. It's not about everyone's flush with cash. Everybody had a liquidity crisis when we first rolled out a year ago or 18 months ago. In other words, wow, we lend it all out and now we don't have enough.
Yep.
And so
Loans are high, capital not so much.
yeah. And so even when we were fundraising for Circle Fund 2, we heard this a lot. Hey, we have a liquidity crisis. And so and you look at research like Cornerstone Advisors' recent research. We look at that very strongly every year, and they do a great job. And so the priorities from Circle Fund 1 are now completely different in Circle Fund 2. And our priorities today, and I could name these, I think I dream about these: deposit growth and retention, number 1; cybersecurity; fraud; operational expense. Can't hire enough people to do a lot of the operations, so that it looks like we need to reduce FTEs and therefore reduce operating expense. I personally think a lot of the AI will fall in that part of it.
That's exactly right.
And then commercial. Everything you hear is there needs to be a reinvention in the community banking space around commercial services and offering products and services to businesses. Especially community-based businesses. So, the community banking space has always been strong in commercial lending. They were built around that, but they might be falling down a little bit. It's an opportunity for credit unions. So those are the 5 priorities right now: deposit, retention, and growth. And our first investment in ModernFi addressed that. Our second investment in Amount addressed the commercial services need. It's a commercial online account opening, amongst other things. So in our third investment is going to center around, member engagement, which isn't a priority, but if you engage more members, you get more deposits. So one thing leads to another. So you get the idea. But that's how things have changed in 4 short years.
Some fintechs may be hesitant to enter into the credit union space if they don't understand it, right? How do you help them understand the credit union space and the regulatory environment that they could be entering?
Yeah, that's a good question. And so obviously we talk about this a lot. We have to abide by the CUSO rule. And the CUSO rule is cumbersome. I had conversations with all 3 NCUA board members while in Washington, D.C. this past week. And this came up. We talk about the need for modification of the CUSO rule. In fact, the CUSO rule needs to go away. It's fact, because it's so cumbersome. So what we talk about is great companies serving credit unions and serving the members' needs that we're bringing to market, and how we could have brought them to market sooner if we didn't have to comply with this rule. And it takes it's cumbersome, right? It's a cumbersome rule. It takes a while for people to understand it, but we are able to overcome that and get through that. I can only think of maybe one company in the last 5 years that said they didn't want to mess with it and walked away. Everybody else who says, I want to be in credit unions, and we say, you have to understand this one little nuance, have stuck with us, and we've pulled them through it. And so that's our job.
Why don't you take a minute and explain what that nuance is for
So the
fintechs who aren't familiar with it?
Yeah, so the CUSO rule says you have to 51% primarily serve credit unions or credit union members, right? And so all of a sudden you're saying, oh, a majority of my business has to be in credit unions. Yes and no. We talk about how we count the 51% a lot of different ways. And so there are people out there that specialize in this conversation. Brian Lauer with Messick, Lauer and Smith comes to mind. He can help credit unions set up the structure to be a CUSO. Not credit unions, I'm sorry. Help fintech set up their structure to be a CUSO and to comply with the rule. When we invest, if we invest in the company, they have to be a CUSO. Right? I shouldn't say be a CUSO. They have to have a CUSO component to their company. And there's a way they can do that. So for instance, when we invested in ModernFi, we invested in a company called ModernFi CUSO, really. And that's how they entered the space through their ModernFi CUSO, as an example. So once we can sit down with the company and help kind of map this out for them and show them how this is not that difficult, they'll usually say, yeah, okay, we get it. And if they're talking to us, Kris, they want to be in the credit union space. So they're motivated to get through this, and we can help them through it very quickly. But there's companies out there, they shy away from credit unions because they don't understand it. They don't understand what it's going to take. But if they're in banks, they're most of the way there. And so we've had people come to us and say, we're in 75 banks and we have 0 credit unions. Will you help us? And the answer is yes, we'll help you. If the product or service resonates with credit unions, we'll help them come into the space. But setting up that CUSO and getting that part of it, the compliance part of it, the compliance piece of it knocked out is where we usually start with that education. So.
Let's talk about the investment side. Is there for a credit union, what's the difference between making a direct investment in a fintech and making an investment through CURQl Collective into a fintech?
Yeah. And we talk about this a lot too with folks, and we understand there are a lot of credit unions out there doing direct investment. We don't advocate that right now. We think that's a risky proposition. And here's why. Many of these founders have been through this. They know how to talk. And if they've been through it, what I mean is they've been through fundraising, they've been through the VC channel, private equity, they've had a successful exit, maybe 2. They know how to do this. They know how to play this game. And so they're very sophisticated when it comes to setting valuations, very sophisticated when talking to people about investing. And what we say is credit unions don't have that sophistication. You don't have somebody on your staff that knows how to do this unless you go out and hire that level of expertise. And that's not likely someone that's going to come to work at a credit union. It's just a fact. And so we see some mistakes being made out there. And what that does is it causes a downstream effect when a credit union makes a mistake on valuation and they invest in a company at too high of a valuation. That causes a downstream effect when it's the next round or the next time the fintech needs money. And so the founder might be saying, rah, rah, look what I did. I got a bunch of money from 10 credit unions at the valuation that I set. The first thing that we ask a company when they come in the door, when they say, I already have 10 credit unions that are in my round, we say, who set the valuation? And so that's usually where the conversation will start when they start out the conversation that way. Who set the valuation? When we invest in a fintech, we either set the valuation with the, collaboratively with the fintech, or someone else has set it, not the fintech. And that's what we look for. We look for that expertise around valuation and who's the one driving the bus in the conversation. So that's where we see mistakes being made, Kris, on the direct investment piece. The other thing that we see is when, say, 10 credit unions got together and they invested in a fintech, and that's going, and they're all using the fintech to their credit. They should be using the fintech. They're going along. They're using it, and now all of a sudden the fintech's out of money, and now they're coming out into the strategic investment world and looking for more capital. The first thing we're going to ask is, are all 10 of your previous investors coming in the round? So what happens is credit unions get fatigued, or they don't realize that a year after they make the original investment, that fintech could be coming around again for more money. We've heard over and over again where a credit union board member or a credit union C-suite member will say to us, we certainly didn't expect them to come back to us for more money a year later. Again, so that's the downstream effect that I'm talking about when we see mistakes being made, that not enough questions were asked or the valuation was too high. And so now when they're coming to us and we're saying, well, we're interested in investing, but the valuation is here, not here. See how I did that? And so those are the things that we worry about when we hear credit unions are direct investing. Now, there's some very astute credit unions out there doing it very well. Don't get me wrong. But that's what we talk about when we see a bunch of folks doing some direct investing. One thing that we are doing is that if we make an investment and then one of our credit unions in our ecosystem says, is there room for us to make a direct investment? Now, we will advocate for that because we've already given the stamp of approval. We've already done all the negotiating. We've already done the vetting, all of that. We have a lot of times we have a room to let somebody in, or we'll ask the fintech to let a credit union in or two, and that's okay. And we also have our fintech coming to us at this point. There's 3 of them that come top of mind right now that are saying we're going to raise a round from credit unions, but it's directly after a round that we already did
and have priced.
So we already did all the due diligence. So that so there's that circle stamp of approval already, and they say, can we leverage that? And we say, absolutely, go for it. We get that. You know, and it's good to have credit unions in these rounds and in these companies. You know, they're going to be the users. They're going to be. In fact, we're helping some of the fintech understand use clauses. You know, I'm sure you're familiar with substantial use clauses and things like that. I said you're going to have to put those in if you want these folks. If you want these credit unions in this round, put in some substantial use clauses, so it creates a win-win scenario where if they use the product substantially, they get some more equity for it and things like that. So those are a lot of the intricacies that we're seeing today in today's world around the differences and some of the mistakes being made out there. But the biggest mistake we see is valuation. And so
do you also
we would rather be in control of that conversation than follow some of those conversations.
Yeah, for sure. For sure. Do you also think it's about timeline expectation? Because when you raise a fund, there is a window that you're expecting to get the returns back in. And that window could be how long?
Well, both of our funds are 10-year life.
Okay. So 10-year life funds, I think sometimes credit unions make direct investments and they think it's like buying stock on the stock market and I should be getting dividends and I'll see something next year from this. Right. Does that also enter into the value of working within the fund?
Exactly. The other thing we talk about, and I didn't answer part of the question from the last question, is the other thing you get with Curql is you get a mutual fund, right? We're a mutual fund. We're broad and we're deep. We're 40 companies in the mutual fund. Now, is your 401k going into direct stock investment or is it going into a mutual fund? Where's your 401k going?
Personally, mutual funds.
Correct. And so we say to credit unions, we're a mutual fund. And so you're getting a broad and a deep fund of fintech that do everything from A to Z. We're in every kind of round from convertible note to Series F. And so there's all kinds of diversity. We say we're de-risking investment on the behalf of our credit unions. And that goes back to that original direct investment versus why invest in Curql. It's all about de-risking. We can talk about risk all day long. Indirect or direct investment, huge risk. Mutual fund, a lot less risk. And so that's what we talk about. So to get to your most current question, which was what? Remind me again what it was, because I went backwards.
Well, it was around timeline, right? It was thinking
timeline.
about
Okay, yes.
the timeline, the expected timeline of a return.
Yeah, we are right now having people tell us, well, we're not sure we're going to come into circle number 2 because we would have liked to see quicker returns in circle number 1. Yeah, and that's a hard one, Kris. That one gives me heartburn because here's why. We have had one exit in circle fund 1, and it was in year 2. It was Payrailz, CU Rails, exited, and it was a very, very awesome return for our investors. And so, but there hasn't been any other. And people are saying, "Oh, we would have liked to seen quicker returns." We've only been doing this less than 4 years. And so what our fund manager always says when he's talking about raising money from credit unions is, remember, this is a long game. We're from Iowa. We have to plant our crops. We have to let them grow, and then we harvest the crops. And the growing cycle is over 10 years. It's not a 1-year growing cycle. It's not a 6-month growing cycle. So you have to remember that. And so we always have to hit that home and hit that hard. But I've had credit union CEOs tell me, yeah, my board expected quicker returns. And so we're not coming in. But I've had a credit union board member tell me before, we tell our CEO that we want to see returns within a year. And all I say is, that's very unrealistic. You're putting undue pressure on your CEO.
Go buy a T-bill.
Yeah. And so those are the things that are out there in the market, though. So you raise a good point. And so that's why. But at the same time, we'll get the other end of it. Well, what if there isn't a happy ending within 10 years? Well, we have strategies that will cover that. That'll be fine. That means they're doing well and they're still alive. Thank God, right? We know that we're going to have investments that don't last 6, 7, 8, 9, 10 years. But knock on wood, all of our investments are still alive today. But we have to say, from a risk standpoint, you have to understand some of them will go by the wayside. Yeah. Some of them will get acquired and we won't see any return. Those are things that are going to happen. But
you can do amazing due diligence and a company can still go out of business.
Yeah. But in every mutual fund, probably 1 or 2 drop out. But the overall return and the life of a mutual fund is historically much better than if you were doing one-off investing. So,
that's right.
And again, that's again what we talk about with a strategic investment fund versus going into things directly.
So many times credit unions will seek investment, or they'll seek the opportunity to invest in a fintech as an alternative to the solutions that are provided by some of the large financial services conglomerates. Right?
Good way to put it. Good. Politically correct.
Are there, when we were starting, one of the things that some of my credit unions were like, hey, we're not interested in selling or being acquired by one of the large fintech services conglomerates. Is that kind of restriction a part of the plan between Curql and the fintechs, or is it more, hey, we're making an investment, we want to go out? If the best buyer is a conglomerate, then the best buyer is a conglomerate.
So back to our original conversation, we're not investing in companies that were started by 5 credit unions all throwing money in to the traditional CUSO model, where they start a company from scratch and serve those 5 credit unions and then maybe go out to market. We're not investing in those kind of companies anymore. Those kind of scenarios are now few and far between. You have to look at today's present day fintech founder, right? And you have a little bit of that mentality in you, right? But, what's today's fintech founder? Great idea. The challenge is getting a product to market, creating that MVP, built, bringing it to market, but then scale and getting that scale. But what's in the back of every single one of those founders' minds, Kris?
Payoff.
Exit.
An exit. Yeah. So wait a minute. I wasn't talking like payoff in the political
No,
sense,
no,
folks.
right, right.
I absolutely meant an exit.
Right, but that's today's world. It's the
Yeah,
reality. In fact,
it
we
is.
talk about when we're doing due diligence in the original conversations. What's the exit strategy? It's
Mm-hmm.
very important. The answer is very important. If they say, "Well, I'm going to build this business up over 30 years and then hand it to my kids,"
Mm-hmm.
we have a 10-year life fund, so you can see we're not aligned already,
Right.
right? Or if they say, well, I'm backed by 5 credit unions, and we're going to start this from scratch, and we're going to build this, and then we're going to see where the credit unions want to take it. We have a 10-year life fund.
Right.
So today's fintech founder is coming out of successful exits. They're coming out of big companies where they have big venture-backed companies, big
Mm-hmm.
venture-backed technology companies. You know how many fintech founders today have Amazon, Google,
A huge number.
eBay, PayPal on their
Yep.
resume? Every single one of them. And they've seen how those companies grew,
Right.
right? So exit strategy is always on the forefront of the conversation early on. But, this isn't your grandparents' CUSO. This is a different day for CUSOs.
Right.
And so when we invest in a company, we know where they're headed, and we're going to help them get there. Now, do we want every single one of our fintech to be bought out by one company in the credit union and banking space? No, we don't.
Mm-hmm.
Because a lot of times the intent of why they're buying them out is not good for our
Right.
credit unions.
Right.
So you have to remember, we're promoting credit unions using these products and
Mm-hmm.
services from the companies we're investing in. It's very important that they use them because it helps them grow. It helps validate their product roadmap, all the things that go with that.
Right.
So if there's an exit and it goes into somebody's hands where they scuttle the company, we have to remember that our credit unions just lost a vendor.
Yeah.
If that's the case, we can't be promoting that. We are not promoting that. We
Mm-hmm.
won't promote that. It's also the reason why we're on every board of the fintech we invest in, because we want to know where they're headed.
Right.
We want to know who's at the table when they're talking about an exit. We want to know when they've hired an investment banker to take them down that path. And so, I call it the big 3. We don't want all of our companies to have this trajectory of I'm eventually going to sell to one of the big 3 core
Right.
providers, because that's probably not good for our credit unions. So,
Right.
but again,
Right.
because of the broad and deep portfolio that we have and all the different types of companies we have,
Mm-hmm.
they're not all going to appeal to the big 3.
Right.
And so they're going to appeal to a lot of different other types of players who are in the space and providing different products and services.
Right. People outside of our industry won't appreciate just how much verbal gymnastics we just did with that question and answer.
And we're going to get calls from the big 3 here when we're done, right?
Well, yeah. Well, they can come on and we can talk, right? We can talk about what the industry means to them.
Right.
So tell me this: what if you got a phone call today, and you're speaking to a class of bright MBA students? What advice would you give them about being an entrepreneur and about building companies? You've seen a lot of it now. You've been participating at 40 companies. What advice would you give to them?
Yeah, that's great. Great question. Wow. It's not going to happen overnight.
Mm-hmm.
You have to be patient. If you're raising money and you think you're going to get it from 2 people, you better talk to 200.
Yeah.
If you're, don't discount your need for a really strong biz dev or sales team,
Mm-hmm.
really strong, who understands the space that you're selling in. We constantly hear of our fintech needing a new biz dev person or new salespeople or new sales team,
Mm-hmm.
because they hired people from outside our space that didn't understand our space.
Right.
The other thing is our space, credit union space, it takes a long time. The product sales cycle is very long. Everyone has a different cycle, slightly different questions. And you just have to try to understand their process and get to the bottom of it. But again, another strategic initiative at Curql that my team is working on is helping credit unions get to yes quicker. right?
Yeah.
How can we help shrink the sales cycle without adding any risk to the process?
Mm-hmm.
And so that's very important as well. So, if they say we want to be in banking, these MBA students say, we're going to be
Yep.
in the banking space. Well, I said, you probably need to clarify that and determine what part of the banking space you want to be in, because that's a pretty broad statement. The other thing is, if they say, I'm going to create an online app,
Mm-hmm.
I'm going to say, there's plenty of those. What's your app going to do? So
Right.
understand your entry point and where you think you can develop a product that's going to be of interest, or not of interest, of need, right?
Right.
Um, you know, I've said this to you many times. Is there room for another digital banking provider in
Right.
the space?
Yeah.
Um, I don't know.
It's a
If
question you have
someone,
to ask.
yeah. And then if they say, well, we're going to start a digital banking platform, we say, well, what does that mean, and how much money do you have?
Right.
Because it takes a lot of money. And
Yes, it
so it
does.
depends on the entry point. I think they need to really understand their entry point, or the jumping off point,
Yeah.
on where they're trying to enter the banking space. That's the biggest thing.
And the services that you invest in, a lot of, it's interesting. I'm in love with this company, and it's not one that you've invested in. It's a new Raleigh-based company called Sequence, right? It's something I've wanted to do for a long time in the industry. There's your free plug, guys. You can pay for a commercial later. But it is a B2C company, right? And I think that a lot of fintechs think about the B2C model. How do I go directly to the consumer? And I think what they miss out on is the structure, the potential capital from working with a B2B partner, or a B2B2C partner. And I think credit unions and Curql really are a tremendous opportunity there, right, for them to do that. I would, if somebody asked me that question, I would probably say, start with a B2B to C model. Don't go directly B2C, because that's so hard to make work. I mean, you talk about, success is getting a little bit more than I had last month, and you miss out on the big partnership opportunities that credit unions and Curql could be.
Yeah. And we see that a lot, Chris. They'll say, well, we tried to go down that B2C path,
Right.
And we're going to stay in the B2C path, but now we're going to try the B2B2C. And I just said, oh, okay.
Yeah.
Okay, I get it.
Okay. You're going to try to
Oh,
eat with both hands.
yeah. But the thing that you have to remember when you're in the B2B2C model, what you're talking about, that they need to really probably be in first, is what's in it for the middle B,
Right.
right?
Yeah.
So a lot of times they'll say, well, it's just a referral model, and they'll help. If the product's so great, they'll just refer us to the C, right, to the consumer, and we'll just thank them. I said, no. There's got to be something in it,
Right.
for the person that's taking you to the C. And so a lot of times they forget that piece, or they don't have that really built out, and they say, oh, we'll just talk to them about how they think that works best. No, have a rev share model today and be ready, because that's what they want, and you're going to have to provide that. It's not just a handshake and a wave and say thank you. The other thing is, we look in the wealth tech space, right? And this, credit unions are pretty locked up with their with the wealth inside the wealth tech space, inside the wealth management space, with contracts and long-standing relationships there. I said, you're not going to waltz into a credit union and say, hey, I've got this great opportunity for you to provide, fractional shares or crypto wallets to your members. I say, well, there's a whole nother layer of people that you're going to have to deal with there that you don't realize. And there's strong contractual relationships there that won't even allow you to have that conversation. And so that's what depending on the entry point, the jumping off point, you have to understand where there's other things that already exist there. So, an LPL, True Stage, people like that, those contracts are longstanding and very solid. And so you got to be careful there too on what exactly you're bringing to market and who else is involved, not just the credit union.
Yeah.
So,
I really do worry about that a little bit though, because it would be like saying that the provider you've had for 20 years, you have to keep regardless of what's happening in the outside marketplace.
right.
Right. I mean,
Yeah.
if you look at the advancements of folks like Robinhood and others, right, and how they've engaged young people and gotten them
Yeah.
into investing and being a part of that, that's a gap for us as an industry. And I
No
worry
question.
about, being able to attract them in the future. And frankly, if long-term contracts are holding us back, those contracts come up for renewal.
Well,
And
yeah.
if
And
we don't
I
make
don't
room
mean,
for, if
yeah.
we don't make room, that'll be a problem.
And those folks, I wasn't picking on LPL and True Safe
No, no,
Futures.
of
They
course.
understand that. They know what
Yeah.
the consumer needs and where the credit unions want to go with this and where they need to go with this
Right.
type thing. And so they're open to that. And so usually, though, what we'll ask is if someone says, I'm bringing um, fractional shares and crypto wallets and other things to the wealth clients of
Mm-hmm.
credit unions, we always say, have you had conversations with these other big
Right.
guys, and do they
Right.
understand it, and are they going to let that happen? Because they'll
Right.
eventually develop their own opportunities like that too. So
Yeah. Yeah. Excellent. Um, so how can someone, if there's a fintech who is interested in, talking to you about opportunities for investment and or credit unions who are looking for the opportunity to put money to work, where should they go to find out more about Curql, Nick?
well, yeah, we're everywhere, right? So they what I'm really happy about, Kris, is we're fairly new to market. I keep saying that we're still a startup. I don't know if we
Mm-hmm.
are or not, and I don't know if people consider that or not. But we've only been in market for 4 years.
Mm-hmm.
But the good news is that our brand is recognizable.
Right.
Most everybody knows who we are, what we do, and where you can find us.
Mm-hmm.
Um, for instance, we'll be at Fintech Meetup, and we're taking 3 from the fund management side, 3 folks, and their
Mm-hmm.
schedules are jam packed full.
Right.
And so every fintech that wants to be in credit unions knows who we are, and they'll be talking to our fund
Mm-hmm.
management side. That's usually, and that's where we start the conversations, because the question the fund managers are really good at our fund managers are good at asking is, what's the product? How does it serve credit unions or credit union members? And then, go from there.
Right.
And we have former credit union technology people doing that evaluation. So
Mm-hmm.
Martin Walker is an example. He used to be at Sound Credit Union. He
Right.
knows he knows all the ins and outs of the tech stack of a credit union,
Mm-hmm.
so he knows where it's going to fit. And then it goes into, what do they need, what does the fintech need, and what's their intent about coming into the credit union space, and then it eventually, 100% of the time, it evolves into an investment conversation. If
Mm-hmm.
it's somebody that a startup in particular,
Mm-hmm.
so. Um, and then we talk about then if we invest in them, how can we help them get to market? How can we help them grow? How can we keep them in front of our credit unions? All of that. So there's a big, broad spectrum of conversation and questions that go with finding a new fintech,
Mm-hmm.
finding a technology. We say we wake up every single day looking for transformative technology as well.
Mm-hmm.
And so there's a lot of conversation that goes into that. But our funnel runneth over. How's that?
It's good.
We have 1,750 fintech in our CRM. And so,
Wow.
yeah. And so people know where to find us, but, reach out at Nick at Curql.com, and that's CURQL.
Mm-hmm.
And we can get you to the right place to start the conversation. But,
That,
credit unions, we're still raising money for fund number 2
mm-hmm.
because of the L word, liquidity. This is a general market statement, Kris,
Mm-hmm.
overall. And we follow the market pretty darn well. The market's been pretty soft for the last 12 to 18 months.
Mm-hmm.
It's taking longer to raise funds in these type of scenarios. We know research tells us that it takes 18 to 24 months to raise money in today's world, and we're at month 18 right now.
Mm.
And so, but at the same time, credit unions probably know we're out there raising money.
Yeah.
They've probably heard. We've talked to probably 250 credit unions directly
Right.
at this point. Our fund number 2, drum roll announcement, as of GAC, which you and I just both got home
Mm-hmm.
from. Our fund number 2 is actually now larger than fund number 1.
There you
We've
go.
crossed over.
Congratulations.
Yeah, thank you. We've crossed over. So it's about 70 commitments, 70 credit union commitments. In fund number 2, there's 68 investors in fund number 1. So that gives you an idea. And there's some crossover, but so I would say right now we have 130 unique investors between the 2 funds.
That's great.
$500 million of assets under management. So
who would have thought just 4 years ago when this was all started? Congratulations.
Yeah, I have to pinch myself because, I say this to you all the time, but you've heard me say this. The largest fundraiser in the history of credit unions in the United States, right? And I said, I hate to say this, but you were number 2.
Now I might be number 3 because you've got 1 and 2. There you go.
So, and we're friends, so I can say that.
Of course.
So thanks for being a good sport about it. But we are pretty proud of that. My gosh.
Yeah.
The first one, there was pent up demand, a lot of liquidity, and it went fast.
Yeah.
This one has taken a lot more work because of the liquidity issue and the changing economic cycles and all that. But I will say what we're doing is still resonating with credit unions.
Yeah.
And that's the important thing that CEOs and C-suites need to understand. You have to be in this, not an investor in Curql, but you have to be at the table talking to fintech and understanding what's coming at you.
100%.
And so, we've always said that this is about relevance. This is about a seat at the table. This is about seeing around corners. This is about letting us be your outsourced eyes and ears, or your outsourced R&D contingent, or your outsourced due diligence contingent, whatever you want to say. There's a lot of reasons that credit unions invest in us. It's not about return on investment. And the credit unions that understand that, and we have to beat this home a lot sometimes with the boards, because they always want to look at the return on investment side, and they want their money in a year, and we're not doing that. But it's why. Our why is still resonating with credit unions. And we heard it at GAC. We got some more commitments at GAC and said,
awesome.
Hey, we've talked about this, and we understand. We need to be in this ecosystem to see these fintech and understand these fintech, and fight against the disintermediation by the large fintech, and fight against those huge budgets that the big banks have. And we're doing it together. So what we say is that at the end of the day, we're going to have 150 credit unions all moving in the same direction, forward around innovating with fintech, not against them, with fintech,
right?
And finding technology that's going to move the needle inside the credit unions and help them grow. This is another way to innovate. That's another way to look at it. This is another way to innovate. So those are the things that we talk about when we're talking to credit unions, and it's still resonating. We're still talking to credit unions for the first time. In our fund, we like to say we're in the 4th quarter of raising money in this fund. And so if you haven't talked to us, you better get in the queue, because it's likely the fund will close sometime in 2025, probably this summer. And so, but again, we are still talking to people for the first time, and we get it when they say it's going to take us a couple months to educate our boards.
Right.
And we say, how can we help you?
Yep.
And we're used to that. And so, get in the queue now and join us, for this ride. It's been an incredible ride. Kris, you've followed the ride.
Have indeed.
And so we're pretty proud of the fact that of the numbers. And again, it's not just about the numbers, but it's more of what we're doing and why we're doing it.
Yeah, the impact is the important part of this.
Yeah.
Listen, man, congratulations. It really has an amazing story, Nick. Thank you for sharing it with us. We are really appreciate you being here.
Yeah, thank you, Kris, for having me. And it's always good seeing you.
You as well, my friend.
This podcast is sponsored by Constellation. We're empowering community financial institutions with innovative digital solutions, powered by fintech, driven by your roadmap. Join us as we navigate the future of digital banking together. For more information on how we can be your partner for digital transformation, visit www.constellation.coop.
That was a great conversation with Nick. I would encourage everybody to check out what Curql Collective does, especially our fintech listeners that are out there. If you like this content, please like and subscribe on your platform of choice. And don't forget to visit our LinkedIn page to see special bonus content. Thank you very much for listening. We will see you next time.